The live trading price for Plug Power Inc. under the ticker NASDAQ Plug is currently sitting at $1.98, reflecting a modest intraday movement of up about 1.54% from its previous close. But the real story lies not in that small uptick, but in the institutional maneuvering beneath the surface that suggests a complex, high-stakes battle for the company's direction is being waged right now. The expectation for a stock that has fallen over 50% from its recent highs is that it is a distressed asset, a falling knife, or perhaps a deep value play waiting for a turnaround. And general market chatter often focuses on the perpetual unprofitability and massive cash burn that have plagued the company. However, the unexpected twist is that despite these very real financial challenges, Plug Power just successfully completed a $375 million convertible notes offering, essentially securing $399 million in cash, which management immediately used to eliminate higher-cost debt, a move that provides crucial, if temporary, breathing room and directly challenges the narrative of imminent collapse that many bears have been pushing on forums and social media. This is a critical development that speaks to the company's ability to still access large pools of capital, a necessary component for any business operating in a capital-intensive infrastructure build-out like green hydrogen. The core challenge for Plug Power remains the enormous investment required to transition from a fuel cell manufacturer for material handling, which is their historical revenue engine, to a fully integrated global green hydrogen producer. And this transition is a delicate dance between building out gigawatt-scale infrastructure and achieving economies of scale before the current cash pile is exhausted. The recent stock price movement, characterized by extreme volatility, is a direct result of this tension. The stock recently plummeted after its third quarter 2025 earnings report, which, while featuring a slight beat on the non-GAAP loss per share, still saw a revenue miss against consensus estimates. The market, fixated on the top line and persistent negative gross margins, reacted harshly, pushing the stock toward its 52-week lows. Yet immediately following that drop, we saw a noticeable spike in trading volume and a significant after-hours price surge, which analysts pointed to as a sign of relief over improved operating cash burn, which was better than 50% lower than the prior quarter, suggesting their internal Project Quantum Leap cost-cutting and efficiency initiatives might actually be starting to take hold. This volatile price action, a significant drop on financial figures followed by a fast rebound on strategic and operational efficiency metrics, tells you everything you need to know about the current investor base. It's split between fundamentalists focused on the GAAP losses and growth investors betting on the successful execution of the long-term hydrogen infrastructure plan and its associated government incentives like the production tax credits from the Inflation Reduction Act. Delving into the specifics of the business, Plug Power's model is ambitious and vertically integrated. They design and manufacture proton exchange membrane, or PEM, fuel cells and electrolyzers, and they are building a network of hydrogen production plants, mostly green hydrogen, to supply their customers. The legacy business is material handling, providing fuel cells for forklifts to major clients like Amazon and Walmart, which remains a solid, if low-growth, core. The future, however, is in electrolyzers, the equipment that uses electricity to split water into hydrogen and oxygen, and the delivery of green hydrogen fuel to industrial clients and large-scale mobility solutions. The Q3 report showed strong growth in the electrolyzer segment, up 46% sequentially,
which is the exact positive signal long-term investors are looking for. The problem is that the hydrogen fuel delivery segment still operates at a high cost, driven by supply chain kinks and the massive overhead of getting their new production plants online. This is why the gross margin figure remains deeply negative despite the operational progress. The market narrative, the expectation, is that Plug Power is burning cash too quickly to ever reach profitability before another highly dilutive capital raise is required. But the reality is that the firm is executing on its most crucial capital-intensive milestones, like the deployment of a 10-megawatt electrolyzer to Galp's Sines refinery in Portugal. This is tangible progress in the construction of the hydrogen economy, not just theoretical planning. And these kinds of large-scale project deliveries are the true measure of execution for a company in this stage of growth. Now we must address the persistent and significant short-selling pressure that hovers over this stock. Plug Power is an archetypal high short interest name with the latest available data showing short interest at over 305 million shares, representing a staggering 23.30% of the public float. This level is exceptionally high and places the stock squarely in the crosshairs of both opportunistic short sellers and retail traders looking for a potential squeeze. The days to cover, which measures how many days it would take for all short sellers to exit their positions based on average trading volume, stands at approximately 2.64 days. While this figure is not dramatically high, the sheer volume of shorted shares is the concern, suggesting a large group of institutional players have taken a definitive long-term bearish stance. Their thesis is straightforward. The company's perpetual negative cash flow, the high costs associated with scaling green hydrogen, and the likelihood of future share dilution to fund operations will inevitably drive the stock price lower regardless of the incremental progress on project deployments. We see major hedge funds and institutions, including some well-known quantitative firms, actively maintaining large short positions, often using derivatives like puts to express their conviction without directly holding the shares, which is a key signal for retail investors to monitor. Investors interested in tracking this pressure can find the official short interest data, which is reported bi-monthly, on the NASDAQ and FINRA websites. It is crucial to pay attention to the short borrow rate, which remains relatively low currently at around 0.59%. Indicating that while the conviction from short sellers is strong, the availability of shares to borrow is not yet constrained enough to trigger an expensive short squeeze scenario. A sharp, sustained spike in the borrow rate, say above 5% or 10%, would be a more actionable signal for a potential short squeeze. Furthermore, the daily FINRA short sale volume ratio has been high, often exceeding 50% on certain days, meaning more than half of the daily volume is related to short selling on the off-exchange venues. This is not inherently illegal, but the persistent high ratio, alongside the recurring failure to deliver data, fuels the transparency debates frequently seen on platforms like Reddit and X. For the retail investor, the actionable insight is not to simply chase the idea of a short squeeze based on the high percentage of float shorted. The capital structure risk is real, and the ability of large institutions to continue lending shares can keep a stock depressed indefinitely. Instead, responsible investors should use the short interest as a proxy for market skepticism. It frames the debate. The short sellers believe the company cannot raise capital without unacceptable dilution and will fail to execute, while the bulls believe the company will succeed in a few more capital raises, hit their production targets, and benefit from government incentives that fundamentally change the unit economics of green hydrogen. The next signals to watch in the coming weeks will be any institutional filings showing changes in large, long, or short positions, and monitoring the open interest on far-dated call options as a measure of long-term bullish conviction. What is your take on the rising short interest, smart money, or a concentrated bet on a macro headwind? Comment below how many shares of Plug Power you currently hold, or if you prefer to trade it via options, and what is your biggest concern about the hydrogen sector right now?